Welcome to a special edition of the BioCentury This Week podcast. I'm Stephen Hansen, Director of Biopharma Intelligence here at BioCentury, and we're coming to you live from the Victoria House in London for our third annual CEO and investor reception during the London Life Sciences Week. Joining me to discuss key takeaways from the week are Luciana Griebel, partner at Morgan Lewis, James Critchley, Managing Director at PJT Partners, and Carmine Circelli, Director of Life Sciences at the British Business Bank. And then from the BioCentury side, besides myself, we have our renowned VP and Editor-in-Chief, Simone Fishburn.
And what you all need to know about that is that I've gone from being esteemed, I can't remember what it was last time. It was something
illustrious.
Illustrious, and now I'm renowned, which is actually also a bad thing, you know.
I have a thesaurus at home, and so I just keep trying to find different words. So we've had about 2.5 days of meetings and company presentations at a variety of venues, I think spread all across London. At least I know sort of personally, I can kind of attest to that, how widespread it is.
Give us your step count, Stephen.
Well, yesterday I had meetings with investors and companies, and I clocked up more than 16 miles of walking across the city. So if you're looking to get your steps in, this is one of the best places to come to if you're that kind of person, which I very much am. Not everyone is, but that's fine. To each their own. But yeah, I think it just speaks to how widespread things have gotten. It's definitely goes well beyond the Waldorf these days. One other little bone to pick with someone, maybe Simone, before we get started. I didn't actually get a badge. I wasn't actually on the invite list. I don't know if that's your fault, Simone. You're the only one that actually has a badge among all of the...
Right.
Did you get? You got a badge.
One.
Oh, Luciana's got a badge. Oh, you had one. It was just Carmine and me that were left off.
Oh, mine's over there.
Oh, you've got one. Yeah. So I'm the only one that didn't get a badge.
So I have to tell you, Stephen, it is not actually my fault. But you know what? If I'd had a say, it would have turned out the same way.
Probably Josh's fault, but we can bring that up later. All right. Anyways, let's dive in. Let's get started. Simone, I'd like to start with you. One other thing here is that, everyone I think is waiting with bated breath to find out whether or not you're going to be dancing with the Kaylee band this evening. I know that you're going to leave us in suspense on your decision about that until later, so you don't need to say anything about it now, but we will be peer pressuring you into trying to do that later. But in the meantime, can you give us a little kind of vibe check on kind of, what you've been hearing this week, what people have been saying?
First of all, I'm not going to talk about singing or dancing, but I would like to know if there's any Scots in the room, and a big, big, big hand for the Scottish football team yesterday. That was something else, wasn't it? Right. So that's all. There we go. There we go. So I don't know that we can score goals of that quality here, but we're going to do our best, okay? All right, so what am I hearing? I mean, let's just talk about the recovery and whether it's happening, okay? That's all I'm going to talk about, and then I'm going to throw it to others for their comments. But here are some words that I've heard this week. It's a more disciplined kind of recovery. It is happening, but it's more disciplined. Another person told me it was a timid recovery. Another person said it's not really better, actually. So there's sort of a little bit of edging towards optimism. And I just want to put this in context, Stephen, that you as our financial writer have in your quarterly previews, I'm going to say going back, 14 quarters
3
now.
years, at least 3 years.
Right,
yeah.
been sort of feeling that we're on the edge.
Always, yep.
And I think everybody is tired of thinking, are we, aren't we? But this time they're sort of saying, maybe this is for real. Let me just add 2 points, right? On the equities market, one person pointed out to me, follow-ons are on fire, right? So that's probably a good thing. And IPOs are certainly, there's more... Not just optimism, but there's sort of more of a feeling of that discipline, that the right companies might be getting out and doing well when they get out. Now, on the private funding side, I think that is where there's still quite a lot of caution and sort of long faces, to be honest. And what one person said this to me, but other people really resonated with this, is still among investors, there is a huge herd mentality, VCs, and this feeling that investors don't want to go it alone. They will syndicate. So we're seeing these large rounds, which is sort of consistent with that because syndicates are going in with large rounds, but there's still a lot of herding.
More concentration.
Yeah, so there's good and bad in that, right? Like on the one hand, there's fewer stupid crap companies getting funded.
Sounds like a good thing.
Which is a good thing. But on the other hand, herding is not necessarily good. We're going to end up with, like we did 1 million PD-1s and obviously GLP-1s and so on. So I'll stop there. That's sort of the sort of quick summary of what I've been hearing this week. And, you take it from there.
Well, James, maybe I can come to you now about, what are some of the key takeaways you've been hearing, and maybe you can frame it around your areas of expertise, which I think spend a lot of time with M&A, right? So that's maybe a good place for us to start.
Yep. Yeah, happy to. So, the words that I heard are positive momentum. So they're the two that I would put into the mix.
That sounds similar to cautious optimism,
indeed,
which is a popular phrase.
That was going to be mine.
So, it would be remiss of me wearing my M&A hat to say anything other than there's lots of talk around the positive deal momentum. Like we've seen lots of M&A, lots of BD activity, and it just all drives this feeling of lots of activity within the sector. So that's really a positive and is featured in, not surprisingly, most of the conversations I've had. I think the second takeaway for me is there's just a very noticeable increase in the number, the scale and the quality of private companies. I mean, again, it's not mutually exclusive to the IPO markets being closed for a period of time, but the number of private biotechs that are now progressing through the clinic with decent capital runway has just been quite impressive in a market shift from, I think, where we were 12 months ago.
There's been a lot of that stay private for longer sort of conversation and, and VCs being willing to keep their companies private longer, right?
Yeah.
So,
and then I think the third and final one is probably that there's a bit more of a focus now, I think, on thinking harder about capital allocation and what that means for things like P&L capacity to fund R&D. Now, again, there's various things that feed into that. It could be results of just natural progression of the pipeline, attrition or positive readouts, or sort of pivoting pipeline into different areas that require increased funding, etc. Or it's a consequence of M&A where people are having to make room in their pipeline in this prioritization exercise. But that's come into a lot of conversations. Again, for me specifically, as it relates to things like asset divestments or whether you really have the right mix and things could be spun out.
Are you talking specifically about like large cap pharmas, or are you meaning like, is that even for like the small cap biotechs?
Interesting question. So yes, for large cap pharmas, but interestingly, we've now seen a lot of M&A and BD activity as well for the bigger biotechs and the mid caps. So I think some of the big strategic questions that you would normally associate with large pharma have started to creep a little bit into the corporate agenda of the mid caps as well.
Sorry, I know we want to bring the others in, so let's do that. But just, one person was talking to me about this rising class. So we've seen Genmab, of course, do acquisitions. We're starting to see the next generation of big biotech sort of being acquirers. We tend to think on the whole of acquisitions as being the farmers, but there's a new class within that, which I think is really interesting to see.
Thank you, James. That was very helpful. That was very interesting. Luciana, I wanted to bring you in on this as well. And if you could just maybe share for me a little bit on just kind of what you've been hearing and maybe just your perception around just the event itself and kind of how it's changed. I mean, geez.
Absolutely. So if you think about it, 3-4 years ago, maybe it was a smaller event, and that's really noticeable now. And there's a lot of energy around it. It's not just the Jefferies Healthcare Conference. It's a whole London Life Sciences Week. And I think that's excellent for the ecosystem. And you can really feel the buzz when you're walking around the Strand and you run into people that you know that are from different countries. And it seems like everyone's coming together in London, which is excellent news for all of us who actually live in London, because we get to see everyone on our doorstep. But it's also good for the ecosystem. And it's also good to see because this aligns very well with the UK government's plan for the life sciences sector. So getting everyone together this week is very good. And I think there have been some parallels drawn with JP Morgan in January. So I'm sure you've heard a lot of that this week. It's a smaller version at this point.
Can I follow up with a question? And it's sort of to you, but also to James, maybe also to you, Carmine, which is, are people starting to time announcements yet around this conference? Is that a thing? Or he's saying no, you can't see it, but he's saying no.
I don't think so yet. I mean, it's because it's always a bit of a nice to have. But I mean, if you think about the cadence of deal flow, many of these deals have been in the works for a number of months. I personally don't feel that it's specifically timed for this in the same way as I agree that for JP Morgan, there might be a nice to have announcement around that time.
Right. So the two key markers that this isn't yet as big as JP Morgan is the fact that you're not timing announcements for deals around it. And you're also not paying $500 for 30 minutes in a hotel lobby yet.
And you can get coffee. You can get coffee in a coffee shop.
You can get a coffee in the coffee shop, yes. until those change, maybe it's, but it's still good. I think, for a European event, it's still, there were more receptions last night than I think I even realized were possible to attend in one night. So, well, Carmine, bring you into the conversation as well here. Can you just, share with me a few thoughts about what you've been hearing this week?
I think the focus has been on large indications from a lot of angles. Spoken about that previously, James. Seeing investor focus, particularly in the private realm, and also I would probably say as a proud European that maybe Europe is starting to scale. So we're seeing a number of companies that have scaled through to commercial sales, which usually is not a risk that a European company would take. But, Verona Pharma, as an example of a UK-founded company, started selling commercially, acquired for a very large sum of money. And I wonder if that's a sign of things to come, staying private for longer and building real scale, and building companies that can be, both impactful for patients, but very significant commercial outcomes for the ecosystem as well.
Obviously, there's the GLP-1s. Are you talking beyond that? Can you expand a little bit on the kind of indications you're talking about?
Yeah. So I think well beyond that, we've seen a number of things in I&I. So, arthritis being a key indication. You've got a number of other things in oncology as traditional areas, and kidney disease coming to the fore as well. There's a strong narrative over obesity, but for us as an investor, it's about supporting and investing in a diversified way across a number of indications that have large impact rather than being overly concentrated in one area.
Yeah, one of the things that we've talked with people about, especially regarding something like the kidney, also cardiovascular, is maybe seeing that go the way of cancer in terms of precision medicine and segmenting that market. It may be a very big indication, but they're going to end up segmenting the population. What are you seeing in terms of the opportunities coming through?
Yeah, I'd probably risk talking about a few unannounced deals. So I'm probably...
You can do that. No, you can just between friends. You can go ahead.
But, I think in our own portfolio, we've got Pure Spring, which is a genomic approach, which is a lot more targeted. But, we're seeing biologics and small molecules really addressing the broader inflammatory pathways or the cellular mechanisms. There are lots of different companies looking at different stages of the disease. And I still think there'll be a number of companies addressing with mechanisms across the broader category of disease rather than being just solely focused on one or another patient subgroup. I know it's easier to get an approval, but you come back to what is of value to pharma and they want a big, broad label.
Thanks for that, Carmine. No, super interesting stuff. So we're going to take a short break and we will be right back.
BioCentury This Week is brought to you by the 5th East-West Biopharma Summit in South Korea. An arc of innovation is emerging across Asia, and Western biopharma leaders are taking note, from cross-border deals to new co's. In March 2026, the 5th BioCentury Bay Helix East-West Biopharma Summit visits South Korea for the first time. Meet the biopharma leaders putting Korea innovation on the global map. Learn why Korea has become a clinical trial and manufacturing hub. Discover if Korea is the next hotspot for new co-formation. Plus meet biopharma innovators from India to Singapore to China and Japan. Register now at biocenturyeastwest.com.
Welcome back to BioCentury This Week. We are live from Victoria House in London. And so before we get started again, we've done these live podcasts over the past year. As I mentioned, I think this is our 7th one. And we've kind of organically developed something of a tradition, I guess, that we encourage our guests to participate in, audience members to participate in if they want to. And it is basically to wear some colorful or interesting socks as part of the show. So the audience can see them, but for the podcast listeners, just to describe for you, to give you a taste of kind of what we have. I don't think anyone can see mine because I'm behind these tables, but I have on some T-Rex socks, which are my 6-year-old's favorite dinosaur, and he very much encouraged me to buy, and so that was why I went with those. Maybe James, I
think James wins.
Tell us about your socks.
Well, I thought London Life Sciences Week wouldn't be the same without a pair of London socks. So
perfect.
Mine have some key landmarks, mostly Big Ben, which is not to be relied upon for actual timekeeping, by the way.
Correct. Luciana, you went with some spectacular shoes. You want to tell us a bit about your shoes?
I decided to go rogue and do shoes instead of socks. I think the most terrifying moment of preparing for this podcast was when you said, I have to find socks to wear. So instead, I decided to go with high heels, rainbow colored.
Perfect.
On a perfect, gloomy afternoon. I thought, what's better?
Nailed it. Yep. Great. Carmine, you have some fun socks there. You want to tell us about your socks?
Yeah, so Star Wars theme, which is a bit odd, but I'll go with it anyway. And they are Obi-Wan Kenobi. Main reason for wearing them is Obi-Wan's a coach and a teacher. And it's really a shout out to all of the CEOs, NEDs, building teams and great companies and coaching and developing the next layer of talent and the future generations of the ecosystem.
Oh my God, you totally win.
Yeah, I did not see that connection coming, but you did a very good job of tying that together. That was great. Simone, you want to tell us about your socks?
Well, I am flying the BioCentury This Week flag with my socks. I'm wearing the socks, so
very good.
Are we all getting those often? Or?
You actually are. play your cards right.
It's supposed to be a surprise at the end.
Sorry.
Holding those in reserve, but that's okay. That's okay. No, very good. Well, thanks, guys. I appreciate everyone participating. It is kind of fun to do that. Now, right. So let's get back to our discussion. We've been kind of recapping the vibe and sort of the interesting tidbits from the London Life Sciences Week this far. I'd like to now kind of transition to more of a forward-looking conversation. So actually, Luciana, I was hoping we could start with you, if that's all right. I mean, so I know that kind of one of your specialist areas is focused on deal making. I think in particular, you were mentioning me a bit about sort of some of the creative sort of deal making that you've been working with and seeing over the time. So can you just explain just a little bit how are companies kind of using kind of creative deal terms to de-risk some of these deals and, still be able to get access to some of these really high quality products? Can you kind of walk us through what those look like?
Yeah, absolutely. So in the last couple of years, I think we've really started to see a shift, and it's not just the very simple, straightforward M&A deals. And in particular at Morgan Lewis, working with our clients, trying to solve some of these problems and address the risks with the transactions and make sure that the products get to the patient. So a large part of that has been moving away from a pure M&A structure and combining M&A with licensing. So there are a lot of licensing elements that get pulled into M&A deals. Earnouts have traditionally been used as a way to bridge the valuation gap, but now we're seeing other things develop. I don't know if you've seen it maybe in some of your deals, but we're seeing a lot of option deals as well. So in an option deal, you would have an upfront payment, and then you would pretty much negotiate the either asset purchase agreement or the share purchase agreement upfront, and then upon a trigger event further down the line, you would have the option to acquire either that asset or the company itself.
So is this like a build to buy type of structure, or is it a modification of that?
It's a modification of that. So we've seen an example recently with a university spin out here in the UK that we catered for from the very beginning. We nurtured them. We started with their Series A and went all the way to the exit, which was done through an option agreement. They were acquired by Big Pharma, and it was a real success story for UK companies, and particularly for university spinouts, to see the whole progress. What's interesting with option structures, and I think a lot of people don't necessarily appreciate that early on, is when you enter into that type of agreement, you're trying to legislate for something that may happen years down the line. And the parties are in a relationship from the very beginning. So there will be some adjustments that the smaller companies will have to do in terms of compliance, in terms of how they actually interact with the buyer earlier than, at a stage of an integration.
So these UK companies, or are they from anywhere? Sorry, the spin-outs, are they from UK institutions?
That particular one I was thinking about was a UK spin-out, but it can be done anywhere with any company.
Right.
It's a way to get funding in earlier, because you would get some form of payment early on and then develop that relationship. And if the data reads out what everyone expects it to do, then you would...
And so is it the tech transfer office? Who's sort of driving this kind of flexible thinking, let's say, or creative thinking on the deal structures? Is it you? Are you coming into the room with that? And is it based still on...
You can say yes.
Yeah,
Yes,
I want to ask you both.
Yeah.
I want to ask all of you, like, where are we in terms of valuation expectations, right? Can we get to that in a minute? But, Luciana, maybe just answer the first bit in terms of who's driving it.
I think it's a combination. I don't think it's a structure that lawyers suggest, that clients come and propose. So it's a known structure. It doesn't involve any tech transfer. So unless there's some element of collaboration or something built into that, the structure itself would not involve any tech transfer. It would just be an initial investment, option agreement. You get the right stage, and then you acquire the asset or the company.
Can we go then now to valuation expectations? Have they reset? Where are we in that curve?
Yeah, I mean, I think of it really as public and private. There's quite a bit of difference. So I think on the public side, we have seen an uptick, obviously, in the number of deals, and we've seen a number of bigger deals. And, we heard lots of people and lots of discussion around have the premium come down a little bit. So we're not seeing these 80, 90% biotech premium as a whole. They maybe come down. We've seen deals in the 40 to 50% kind of premium range. I think what we sometimes miss is that for these public company announcements, the share prices have actually traded up materially into the deal announcements. And it might be because companies had better than expected launch of a product, or it might be that, the markets are rewarding high quality late stage data sets, etc. So
like Cidara, I mean, I think that was a pretty interesting one where they had really positive data. And I think they did a follow-on deal at like $44 per share, and then traded all the way up, I'm sure as the discussions were ongoing, traded up to about 105. I think it taken out for over 220.
Yeah.
Right. And Stephen, isn't that the one where you sort of basically posed the question, like, did investors undervalue it or
I was just wondering whether did Merck overpay, or did nobody really appreciate the value that they had post data, which was July, and so.
You might want to remind the listeners, like, how much that went for.
Yeah, it was $9.2 billion, I think, total. Yeah. Merck's acquisition of Cidara. So,
Yeah, but it has definitely fed into the decision-making for a lot of these later stage deals because, there's only so much more headroom you can have in your models. We've also seen some CVRs coming back in, which, helps with
I was just going to ask,
that's been a feature for 2025.
I was wondering if that was sort of going to be more of a mainstay feature, because I was actually kind of surprised that didn't feature in that Cidara deal, as you would have maybe thought that would be built in. But obviously we saw it in the Metsera deal. We've seen it in several others. Yeah. Is that a pretty common expectation now, that there's going to be some level of trying to mitigate the risk?
I think it's definitely been a feature in a number of deals, and it's been a feature in some of the deals actually where it didn't end up announcing with a CVR or CVR features as part of the negotiations. So it's a way to sort of bridge that risk and value expectations. So it's a mechanism that you will often see when share prices are running quite high.
Sorry, we're already going a little off piste here, but just stick with me. Because I always thought that CVRs initially kind of came in when there was maybe higher concerns around sort of, risk and things, and like maybe it wasn't as competitive. But again, so maybe going back to that Metsera example, I mean, there were 7, 8 sort of suitors there. So it's not like that. I mean, that was a very competitive deal process. Yet you still ended up with a CVR, a fairly sizable CVR aspect. I mean, I think it was $2.5 billion in the end. I mean, is it no longer, because I would have thought that in a really competitive bidding process, like getting rid of the CVR would be a way of sort of, trying to entice, a company to accept your bid. I mean, is that still the right way to think about it?
Yeah, I mean, look, we've definitely seen examples of what you just described. And one deal that we worked on was exactly that situation where a CVR was proposed, a $20 CVR was proposed. And actually we counter-offered and said, drop the CVR, we bumped $2 and the deal got done. So, yeah, look, I think it does feature. But ultimately, it's a combination of, as you said, the composition dynamics within the process, the actual, remaining sort of risk profile of the asset itself, because we have seen some companies have been acquired perhaps at points where I think everyone was thinking it might de-risk further, right? So there are key, obviously, M&A catalysts, as I call them, which is typically a data event or similar. And we have seen some trade where folks have preempted and moved before, a pivotal data set. And I think that's just indicative of a competitive market and high strategic need.
All right. Well, you raised Metsera. There was the obvious popcorn value in watching that play out. And then we had Lundbeck. Are we going to see more of that, or is it just too often in terms of, you thought the deal was done, I have a superior offer for you?
Yeah, I mean, look, it's a very interesting point because we haven't been in a world where we've seen people interloping for quite a long time. And I guess with Metsera, Novo was in that process allegedly to begin with.
Company one.
And indeed, look, I think it's essentially indicative of a competitive M&A market. And as I said, the strategic need and desire for assets that fit within the core area of expertise of a company. And we've seen that with people acquiring assets that actually are almost a mechanism to defend a core franchise within their business. So it just gets very competitive very quickly.
I'd not been prepared to have gotten so deep into the weeds on the legal definition of a superior company proposal as I have in the past month. Didn't realize I was going to go on that road. It's been a very interesting, as you say, it's been a very competitive, and it just feels like, is there firepower for this to continue? What can you talk a bit about the supply and demand that's out there, James?
Yeah, I think in general, there is sufficient firepower. Many of the companies can have debt capacity into the tens of billions. There are one or two that are at the other end of the spectrum. But in general, I think the balance sheet capacity remains. What's interesting is to think about funding the deals once they're done, depending on that profile. So P&L capacity in the R&D burn becomes a talking point as well.
Yeah.
And that's something that has actually come up in various conversations during this week about P&L capacity and what happens after you acquire the company.
Yeah. Carmine, I did want to ask you, because I know that you've been working on some interesting stuff, and we actually didn't get a chance to talk about this beforehand. So I'm hoping I'm not catching you off guard too much here. But, we had talked a bit about some of the work you're doing around venture and some of the returns there. And I know that that's one of the bigger conversations that's going on this week, and especially in the UK, around the initiative to try and get pension funds involved and try and get pension funds more exposure to alternative investments such as venture. So can you talk a little bit about kind of what you're seeing there and maybe kind of how far we are along in that process? And please tell me that you have some visibility on actually getting pension fund money into some of these venture capital funds.
So just to cover it off, actually, by way of background, we're both a large LP, which means we invest in fund managers. We've been doing that for a very long period of time, been doing it across sector. So the first point I want to make is, in general, people perceive life sciences to be high risk and fairly low return versus other sectors. And I can say that that's not necessarily true. Bruce Booth's published it repeatedly, and we see that in our own data set. We see good liquid returns over reasonable investment periods and strong IRRs. And that really feeds through to the argument that the industry needs to make to the institutional investors. Not that they should specifically invest just to invest, but much rather it's in their financial interests too, because of the way that ultimately the industry is productive for investors, has great patient benefits. So what better to do with your money than both have an impact on patients' longer, healthier lives and good returns for your savers. So it's about making that campaign. And in terms of what we will hopefully see over the next kind of period or window, is that start to solidify. We're seeing a number of the major institutional investors building their own investment teams, some of them with sector-specific focuses. I'm not going to call those out for obvious reasons, but it's available on the websites. And then for ourselves, it's publicly announced that we are working with the industry on the British Growth Partnership. And hopefully there'll be more news on that soon.
Can I just follow up a couple of things here? So on the pension fund reform, I was talking to somebody about this, and obviously there's this argument that, is brought out quite often and correctly that look at what's gone on in Australia, look at what's gone on in Canada, look how well those pensions have done, and look what you're doing. And, what I hear is the pension sort of funds go, yeah, I get that. But still, it seems a bit risky to me. So, you can change the law, but are you going to change the behaviors and the risk appetite?
I don't think we can change the law, unfortunately.
Well, you can't, but one can. The law can be changed.
I'm not in a position to advocate in either direction on that. But the point, I suppose, is there are an awful lot of other structural considerations that are specific to venture. So if we think about, first of all, day-to-day pricing, which is essential for a pension fund, you've also got structural, how do you flow capital from savings into an illiquid asset class and back out. The advent of LTAFs, which BBB have supported recently. So there's a 250 million investment alongside Phoenix Group. It's a very large institution. And that's now managed by Schroders as an LTAF, essentially. So it's about seeding these new products and new channels to effectively allow the industry to have access. In the US, that happened in 1978. The ERISA reforms were the kind of core piece of that. And for us in the UK and Europe, it's a template that ultimately we might have to follow in order to achieve what we want to achieve in terms of broader funding for innovative companies. Those structural pieces, I think there's another thing about how pensions are ultimately sold, for want of a better phrase, how mandates are acquired. But I think these are pieces of the jigsaw that are starting to come together, and there's definitely a concerted effort for people to work on this issue.
I want to follow up on something you talked about with the perception of risk in biotech, and I don't think anybody is going to pretend, anything other than that. But one of the themes that's come up this week in just about every single conversation, of course, is AI, okay? And so we're talking about these equity markets I didn't raise before, but, when the AI bubble bursts, I think most people are saying when, not if, but when. What does that mean? And so there's this idea that, okay, everything's going to get dragged down, but then there's this open question as to whether you then get this flight to biotech. Does biotech become the flight to safety, as we saw in the pandemic? And I'm just sort of wondering what you all think about that.
Yeah, what happens? If it bursts, does everybody sink, or is biotech an island of safety?
Because there's always patience, there's always patience.
Albeit a high beta island of safety.
No one wants to be such difficult questions. Yeah, I mean, very, very, very hard to predict. So I think we've probably already started to see some of the NASDAQ cooling off a bit and coming down as that AI sort of rhetoric cools a little bit. I think it's selectively within biotech, there's almost been assets have continued to be rewarded quite well in the markets upon positive data sets. And that is fundamental and specific to biotech. And I very much hope that will continue. But, naturally, as markets come down, it just leads to a broader input to broader sentiment.
Excellent work not answering the question there, James.
I'm giving the politicians' answer to predict whether it will come down. So I think the high quality biotechs with positive data sets are going to continue to be well rewarded for it. The rest of it will just be a sentiment value, which may just see generally the markets come off with it.
So kind of be a bit more direct, hopefully less encumbered. The first thing I would say is that 80% of all biotech transactions are trade sales. Only about 20% are into the IPO range. So there's a natural insensitivity in the returns market on the basis of reliance on public pricing. There are some great public companies, I'm not going to deny that, but it's not for the majority in terms of real cash-to-cash transactions. And then building on that, when we look through that broader data set and we see the liquidity profile coming back, it's stable over time. And it actually, when we cross-correlated it, is inversely correlated. So it almost directly opposes returns from all of the sectors. And the really strange thing is it is actually inversely correlated to public biotech. So you'll actually see strong returns even when public biotech is suffering from the private biotech market.
For private biotech.
For private venture biotech. Yeah. And we see that in our LP data. Right. And
that's a good note for anyone who's heavily overweight on AI at the moment. They need to swiftly switch into transition into private biotech to make sure they can capture those turns on the downfall.
I'll probably just add one more point, which is, when we've seen a cycle of M&A and this, to the extent that we have over the last number of months, there is going to be a natural recycling of that money, right, where, sector-specific funds and PMs need to put that money.
There's a lot of specialist money that was in those names that can then reinvest in their other names. So, yeah. Well, good. Well, Simone, I'm going to come to you last. Not that you're last, but you just happen to be last in this one.
Yeah, illustrious. No, what was it today?
Two things I would like you to give your perspective on, kind of in a forward-looking manner. So, clinical trials and timelines and speed, those sorts of things. And then can we talk about the sustainability of the NewCo trend, the cross-border deal-making trend, and whether you see that continuing into next year? And I will give you the choice to start with whichever one you want.
Yeah, I'm going to take my editorial license and go for the second one first. This is what we do. We get drafts from our writers and then we move them all around.
Gee.
Right. So what I'm going to, I think in terms of the China NewCo model. So the other thing we haven't yet talked about is China, which is extraordinary given, for me, this is the year, and everybody who's listened to the podcast has heard this many times, this is the year that the rest of biotech woke up to China. But one of the things that, came out of like listening in our China conference was you talked about creative models. So in China, they came up with a NewCo model, whereby when the capital markets were extremely constrained, biotech companies would outlicense assets to create new companies, NewCos in the West. Now, we all know that's not actually a new model. That's been going on. It's been going on in tech forever. But there was this sort of wave of it. And I think what was particularly important was it was coming out of biotechs. It wasn't sort of coming out of academia and being planted elsewhere. And so there was this big wave of them. And now the question is, whether that's going to continue. Obviously, the capital markets have opened up a lot. Hong Kong market is...
IPOs have opened up. We haven't... So I was looking at the data, just the updated data we had through last week, and we haven't seen a material move in terms of the number of venture money that's being raised in China yet. So that's not moving, but that doesn't mean that it won't be moving. It feels like that's starting to come back as well. Right.
So there's certainly a feeling less of like there's no place to go for money, right? And so, there is this, some people sort of think that the NewCo model was a wave and it'll sort of simmer down. But then there is another organization that is actually really doubling down on this. They're raising a very big fund specifically to fund NewCos in the West. And so it's a sort of bifurcated scene. We don't know which way it'll go. I'm not going to predict which way it will go. But I think that there are people who certainly see a lot of opportunities, some of which may have a geopolitical angle to it, but a lot of opportunities in taking these China assets and then developing them in the West.
Yeah, I mean, I know I spoke to a couple of companies this week who, specifically mentioned the fact that they were investing a lot of time and energy in making sure they had people on the ground there, people that, spoke the language, had local access. And that was where they felt like it was sort of the one last place in the world where you could potentially find a diamond in the rough and find something that is actually, a real high value asset that you don't pay a high value price on. But, I think there's probably going to be a natural equilibrium that comes at some point, right? Because as these asking prices go up, or if they ask for more equity, or, whatever the flavor of the deal making is, there's probably going to come a point to where there's some sort of equilibrium that, where then maybe farmers or VCs say, well, actually, I can get something just as good from a struggling U.S. public biotech or something like that.
So now we get to the bit of like, where does China biotech fit into the overall global growth of the ecosystem? And sort of, I personally think that there's just going to be continued assets coming out of China.
No, I agree. I'm not saying that there are, but I guess I'm saying that I imagine there's sort of a crest to the wave at some point.
Of NewCos.
Yeah, I think it'll continue to feed into the early stage R&D pipeline as assets come out of China and pharma companies develop them, because lots of those assets that we're seeing, including the NewCo models, some are being developed through to sort of mid-stage development, but typically they're brought in at a relatively early stage. And then, as we're seeing at the moment, the wave of M&A really has been more skewed towards the more mature late-stage assets, and that's coming more from the standard, US public market.
All right, so let me come to the exact opposite of that. So a lot of the NewCos, in terms of what you call late stage and early stage, and this is to your second question, Stephen, a lot of the NewCos are coming with clinical data, of course. A lot of companies in the West are still saying to me, oh, can you really trust that data and whatever? Remember, you are comparing clinical data, early clinical data with preclinical data. So it is massively de-risked. Now, the real thing that I want to talk about, though, is what I believe is going on. This, for a long time, South Korea, Australia, other regions of the world have really wanted to become a destination for clinical trials. And what's coming out of China is like everybody is waking up and going, oh, we really need to make that happen. In the UK, we've got Lawrence Talon, the new CEO of the UK regulator, MHRA, and he has set a goal to, first of all, reverse the decline, where the decline is a increasing lag in clinical startup times. But I think they want to be even more aggressive, and there's certainly a lot of effort going in here to enabling clinical trial startup times to be faster. And this, I think, is what we at BioCentury are going to be watching and gathering data on. Many countries now feeling that this is an area where they can compete, they can provide value. A lot of it, Patrick Vallance has talked about that, that's the Minister of Science here, is about getting more patients, eligible patients, into clinical trials. And so I think that actually is sort of, China's basically raised the bar. They may continue to deliver on that, but they've raised the bar for all these other areas in the world to start saying, we need to enable clinical trials
faster. Everyone's trying to play catch up.
Yeah, and I mean, even FDA, I shouldn't say even, and FDA is recognizing that and talking about making it faster to get into the clinic. We'll see what goes on there, but I think it's a really important area because I think that just cutting down the dead time of dead translational research, which is going on, and preclinical models, some of them are good, but many of them just don't have predictive value. So really trying to solve that bottleneck, I think, is key. And you'll hear me say this over and over again, so you can keep tuning to the podcast to hear me say that.
Wonderful. Well, thank you, Simone, for the final word, a wonderful final word. That is all that we have time for this week. So I'd like to thank our new Podcast on the Road sponsors, the British Business Bank, PJT Partners, and Morgan Lewis for their supports. Also, a huge thank you to our live audience for joining us for this special edition of the BioCentury This Week podcast. And thanks to all of our listeners for tuning in. I believe the BioCentury This Week podcast will be back on the road next year at the Life Sciences Week West, JP Morgan, I guess, annual. I don't know.
Redo that, but that was rubbish.
They don't all work. Okay. The BioCentury This Week podcast will be back on the road next year at the JP Morgan Annual Conference in January. Thanks again for joining us. We'll see you next week. All right, we're done.